Good morning, everyone. Welcome to our confidential report for March 2023. It's been quite an interesting month, if a little short, only 4 weeks in this month, so this report will not be that long. Begin as usual with America and Wall Street. You may recall that the Ukraine war, when it started on the 24th of February last year, the initial effect was to push the oil price up quite sharply, and that had the impact of raising world inflation, and particularly inflation in America. The result of that, in turn, was that central banks began to increase their interest rates, and that caused a bear market to begin in January, on the 3rd of January 2022. In our view, that bear market was about 18 months too early. In other words, the Ukraine war caused the bear market to come about 18 months before it would have otherwise. And remember that it came at the end of a 13-year bull trend. That bull trend began in March of 2009, and it had been going on for so long that thousands and thousands of small private investors had gotten into the habit of buying shares, especially buying on the dips, and then waiting for the market to give them a tidy profit. They didn't really have a great deal of knowledge about the market. They didn't know a great deal about the instruments they were investing in, but they bought anyway because it was a profitable experience. So they had that experience for a long time, 13 years. Many of them had never before been in the share market and had no experience of what a bear trend was like or how it unfolded. So when the Ukraine war started and oil prices went up, causing interest rates to rise and a consequent bear trend to begin on the S&P 500, these people were confused. They didn't understand what was going on. And many of them have retained their optimism in the face of the downward movement on Wall Street. And that optimism is quite widespread. I think a lot of the participants who are now investing in the share market in America and other markets have never before seen a bear trend, and they are completely unused to what is going on here. And they're causing the market to move in a strange way. The bear trend is not unfolding as it would normally unfold. We only expected this bear trend to really begin in about the middle of 2024. And of course, at the time that the bear trend began, at the time that the war began in Ukraine, the Fed was not really concerned. The American Federal Reserve Bank was not really concerned about inflation. In fact, they were saying that the fact that inflation had risen to 5% was not a major issue. It was a temporary factor. And the war, of course, took all of us by surprise, including the Fed. So there's a lot of residual optimism in the markets. That's really what I'm trying to say. Tens of thousands of small private investors are reluctant to accept that we are in a bear trend. Most of them are completely inexperienced. They've never seen a bear trend before. They've only ever seen a bull trend. And there are a number of effects that this residual optimism has had in the markets. First of all, of course, it prevented a one-day crash like we had in 1987. So the market did not come down like it did in 87, where it fell 23% in a single day. It's also produced 3 very powerful bear trend rallies. I'll just put that on the screen for you. Put 2 years on the screen. Here you can see the bear trend rallies. There's the first one there that occurred in about March, April of 2022. The second bear trend rally was this one here. And then we are in the middle of the third bear trend rally, which, as you can see, was interrupted by the festive season and is now in the process. It has peaked out, I think, and it's coming down. So 3 major bear trend rallies. It also resulted in a very strong market response to any positive news. So if there was any news coming out in the marketplace that was at all positive, the market over-responded to it. and pushed index levels like the S&P 500 up to unusually high levels. And of course, there's deep entrenched resistance to the idea of a continuing bear trend. And there's been a lot of buying of the dips. As soon as the market dips down, there's a lot of investor buying of those dips in the hopes that they will make a profit, as they used to during the bull trend. And they also have the belief that the Fed, the Federal Reserve Bank in America, will pivot soon. In other words, what they mean by that is that they will change their stance and stop increasing interest rates and start reducing them. That's called a pivot in monetary policy, as produced mainly by the Federal Reserve Bank, but followed by other markets around the world and other central banks. However, we can see that this is not likely to happen. Now, after the Monetary Policy Committee meeting in America in January, Jerome Powell, who's the governor of the Reserve Bank, came out and made some remarks, answered some questions after his talk, which gave the markets room for optimism. He basically said that what he said was too dovish. He said that the Fed was aware that the direction of inflation had changed because inflation had been coming down for 6 months by then. And the market got the distinct impression that there would be maybe 2 more 25 basis point increases in interest rates before the Fed pivoted, turned its policy and started reducing interest rates. The result of that optimism was that the S&P climbed on that day 2.5% and went up to this resistance line at 4170. And you can see, if you look at this resistance line, it was originally established here as a support line way back in February and March of 2022. Then you can see here in April, May, there was a bit of backing and filling around that resistance level before the market fell through it and then came back up, and then that resistance level, that support level became a resistance level, and the market went right down here. And again, you can see that there was this zone over here of backing and filling. And then we broke up through that resistance and then came down. And again, there was that area of backing and filling. And then now you can see that in the most recent third bear market rally, we've hit an absolute ceiling at this level of 4170. Okay, so now let's go to the more sort of right up-to-date chart here. This is the last 6 months on the S&P 500. And you can see that the cycle low was at 3577, and it was made on the 12th of October last year. Since then, the market has rallied, and there was a bit of a sell-off over the festive season and a sideways market. And then when investors came back after Christmas, they were full of optimism, and the market went up strongly to reach that 4170 resistance, and it fell back from there, and it's basically been falling ever since. Notice also the two moving averages here, the 200-day simple moving average and the 50-day exponential moving average. The crossover of these two moving averages is known as a golden cross, and it occurred on the 30th of January, at the end of January this year. But I believe that was a false signal, a premature signal, and I think it will cross back down. The 50-day exponential will cross back down through the 200-day simple moving average in the next few weeks. And anyone who bought in here on the 31st or the 30th of January will basically be whiplashed. Okay, so that's kind of where we stand. In our view, inflation in America has not yet seen its worst levels. This has been borne out by the fact that in January, the American economy generated an amazing 517,000 new jobs in a single month. That was about double what economists were expecting, and it was way over the top. The unemployment rate came back down to its record low at 3.4%, which is basically a level which is equivalent to full employment. When you have full employment, it means that employers are really struggling to find staff to run their businesses. There's a huge demand for staff, and there's not enough staff to fill those positions, with the result that wages start to go up, which is obviously inflationary. But to sum up, there doesn't seem to be any real evidence that the economy in America is cooling down, despite the rate increases that we've seen. Okay, so the golden cross signal came a bit too early and will probably result in something of a whiplash. I'd just like to draw your attention to my tweet, which I put out on the 9th of February, 2023, where I said this. This was on the 9th of February, so let's just have a look at that day. It was, in fact, this day here where I'm pointing to. And you can see it was a bit of a downward day, but it came just after the market had rallied to reach that resistance level. What I said on that day was, Powell's unfortunate remarks have caused a burst of investor optimism. However, the S&P 500 has found a ceiling at 4170. We expect this level to hold and the S&P to fall back from this level. And you can see that from that day, it basically has fallen back, and last night closed down quite significantly at 3970. So we're expecting it to continue down, and in fact ultimately to break this cycle low, which you see here of 3577, which was made on the 12th of October. So that's our expectation. This will go down for the next month and a half or so and make a new cycle low. Looking at the actual economy in America, GDP grew by 2.7% in the fourth quarter of last year. That was less than the 2.9% of the third quarter, but still a very strong growth. And of course, we've got to add into that the 517,000 new jobs in January. And I'm quite sure that if the Monetary Policy Committee in America had known that there was going to be over 500,000 new jobs in January, they would have raised interest rates by 50 basis points, not 25. But they were caught completely by surprise, as was Jerome Powell. Many commentators, however, throughout the world are now expecting a recession in America, starting sometime this year, but they say it will be relatively mild. Our view, is that it will be much worse than expected when it comes. It will be basically stagflation, which means a stagnant economy with relatively high inflation. There are a few sectors that are starting to respond to higher interest rates. Tech shares obviously have been quite vulnerable, media shares, and of course housing has responded. But most of the sectors on the S&P 500 are going up. So we still see this as a problem for the Federal Reserve Bank, and we believe they will have to raise interest rates higher and for longer than is generally anticipated by the market, and that will cause the share market to fall into a further bear trend, this correction that we're in now to continue to deeper levels. All right, let's turn our attention now to Europe and to Ukraine, of course. There's been a lot of concern over the last month or so that Russia would mount a big offensive to coincide with the anniversary of the start of the war on the 24th of February last year. That has proved to be unfounded. There has been some additional pressure around Bakhmut and the city of Bakhmut, and Russia has made some small gains in that area, but at very substantial cost in both men and materials. The anniversary has come and gone. There's also been a lot of speculation about a Russian spring offensive, where they will attack heavily in the spring when the ground becomes a little bit more easy to transverse with these very heavy equipment like tanks and guns and so forth. But we now think that it's more likely that Ukraine will mount such an offensive and will probably take more land back from Russia in the spring and the summer. And it will, of course, use the new tanks provided by NATO to take back this territory. Joe Biden's visit to Kiev was superbly timed, coming just as it did just before the anniversary of the war. It showed huge support for Ukraine and sent a strong signal to Russia. It shows that NATO is unified and they are very determined to continue supporting Ukraine. There is no evidence that NATO is breaking up or having second thoughts about their support of Ukraine. The message to Putin is clear. He cannot possibly prevail. Putin's efforts to get Belarus into the war have been largely unsuccessful. A recent speech by the Belarusian president, Alexander Lukashenko, indicates that the Belarusian people are not interested in getting into this war, and they probably won't stand for it. There's also the consideration that Belarus must have, and that is that there's now a very heavily armed Poland that will probably come to Ukraine's aid if Belarus gets involved in the war. Poland has been hugely armed by NATO because it's a frontline state and the next possible target of Russian aggression. The decision by Germany to send 14 Leopard tanks to Ukraine is very important. Obviously, it was stimulated by the British decision to send some Challenger tanks to Ukraine. And Germany also, importantly, has allowed other European countries to send their tanks as well. There are about 2,000 Leopard tanks in Europe, and the Ukraine Ministry of Defense says that it has received promises for 321 main battle tanks from European countries and America so far. Of course, not all those tanks will arrive immediately. It will take some time, but probably about 100 will be there in time for any sort of spring offensive that President Zelensky has in mind. And of course, these include British Challengers and American Abrams tanks. And of course, all this looks like an escalation of the war. But what it means is that Russia is in a very vulnerable position. With these tanks, it seems unlikely that Russia will be able to keep Crimea until the end of this year. And to us, it seems unlikely that Putin will survive the loss of Crimea. If Ukraine can regain Crimea, I think that Putin will be in very, very difficult territory. Remember that his allies, Prigozhin, of the Wagner Group, and Kadyrov, who's the Chechen leader, probably have their own agendas. And it's conceivable that these agendas do not include Putin. Many commentators are talking of a protracted war that will last years. We do not see that. We believe that Putin cannot survive for very much longer. A further major defeat by Ukrainian modern tanks will finish him. Remember one thing about dictators and authoritarian leaders. They can survive lots of things. They can survive atrocities, they can survive immorality, they can survive stupidity, they can survive rank dishonesty, they can survive sexual perversions. But the one thing they cannot survive is to be perceived by their followers as a loser. This is essentially what has happened to Donald Trump. His followers were quite happy when he was shown to be a sexual pervert, when he was shown to be a liar, when he was shown to be dishonest and to breach the Constitution. None of those things worried them. But now that he's been shown to be a loser, he is losing support rapidly. The same thing is happening to Putin. He's been shown to be a loser, and that will be his undoing in our view. So we look for a resolution of this war sometime probably this year. And maybe President Biden knows that. And of course, NATO and America are benefiting enormously from this Ukraine war. Their longtime enemy, the USSR, now reduced to Russia, is being destroyed both militarily and politically. And this is being achieved without any of their soldiers having to fire a single shot. Not one NATO soldier or one American soldier has lost their lives or got involved in this war in any way at all. All they've had to do is to supply materials. And of course, they're very happy to do that. They're very happy to supply their latest weaponry to Ukraine because now they can test it out in a real-life situation and find out how effective it is against Russian weaponry. So they're very, very happy with the situation, and I think it suits both NATO, the European countries, and America down to the ground. It's also had the amazing and unexpected effect of unifying NATO in a way that nobody could have predicted. That unification has had the effect of even scaring China. They realize that NATO is now an extremely powerful force in the world, huge economically. I mean, both Europe and America are much bigger economically than China, each individually, and together they represent an enormous force. And in the end, these wars are all about economics. I mean, that is exactly why Russia is losing this war, because it's a relatively small economy and it's trying to take on the two largest economies in the world. And they've now had a year to prepare and they're gearing up. The Americans are making more and more arms and ammunition to fight in this war and to replenish the stocks that they've given to Ukraine. All right. Okay, now let's talk a little bit about Eskom, because plenty of things have been happening there. Our president has declared a state of disaster in an effort to try and control and contain the load shedding that's been going on throughout our country. He's going to appoint a new Minister of Electricity, whatever that means, whose primary function will be to cut through government red tape and try to get as many gigabytes of power onto the grid as he can as quickly as possible to avert this load shedding, which is basically having a negative impact on the economy. The Reserve Bank is now predicting 250 days of load shedding in 2023, much worse than its original forecast. And of course, because of that, it's reduced its forecast for growth this year to just 0.3%. That's growth in GDP, gross domestic product. We also heard that the Reserve Bank is planning for a complete collapse of the grid and what that will mean for financial markets like the JSE and other markets. And then, of course, in this last month, we've had this explosive interview by ENCA, by E-News, with Andre de Ruyter, the previous CEO of Eskom. Of course, it coincides with his immediate resignation, because he is basically doing something that takes a lot of courage. He is speaking truth to power, and that is always dangerous. De Ruyter has basically exposed the systematic corruption within Eskom for all to see. He says there are 4 mafia-style organizations stealing roughly R1 billion a month through corruption in Eskom. Of course, this is coming at a time when Eskom is trying to get an 18.65% increase in their fees, and will make electricity users very reluctant to pay that, because obviously a lot of that money is going to go into the pockets of crooks, and none of us like that thought. Of course, a major cause of the current load shedding is the interruption of the coal supply. Apparently, these mafia-style organizations sabotage the railway lines so that coal has to be delivered by truck, and they divert the trucks, take the high-quality coal off, substitute it with poor-quality coal, and then sell that coal to make that high-quality coal to make a nice profit for themselves. And at least one senior person within the ANC is involved, according to De Ruyter. We don't yet know who that is. It's interesting to note, though, that De Ruyter had a privately funded investigation of Eskom done before he did this interview. And that investigation, the report from that investigation, has been leaked to the Business Day, and it substantially confirms what he said in the interview. All these facts are there. One ANC, senior person in the ANC, when trying to explain to De Ruyter why he was not being successful, told him that he was not giving the comrades a way to eat. In other words, he was not allowing the corruption. And that was the problem. That was the reason he was not getting the cooperation he needed. De Ruyter is also concerned about pollution. He says that 29,000 people die every year in South Africa from air pollution. Doesn't surprise me that at all. And Eskom is a big contributor to that. Eskom also uses apparently about 40 billion litres of water a year, which will contribute to a water shortage, especially in Gauteng, in due course. And there's a big danger from the European Union's carbon border adjustment mechanism, the CBAM, so-called CBAM. The European Union is threatening to stop exports from countries which do not control their carbon emissions. That could impact us very badly because they basically absorb about 56% of our exports. You can imagine if we become victims of CBAM, that will have a very bad effect on the economy. The De Ruyter interview has raised howls of anger from the ANC. Even Pravin Gordhan said his revelations were unfortunate, but has subsequently said that much of what he said is true. So essentially, Gordhan is saying they are unfortunate for the ANC, which indeed they are. But I believe he has done South Africa a great service by highlighting the real problems in Eskom. His efforts have even resulted on an attempt on his life. Okay, so the load shedding and the problems at Eskom dominate everything in the economy and in the stock market right at the moment. But looking at other things in the economy, inflation fell in January to 6.9%, down from December's 7.2%, much closer to the Reserve Bank's target range of 3 to 6%. Core inflation, which excludes food and fuel, was 4.9%, which is the lowest we've had for 3 months. Of course, we have to remember that the rand's weakness, which I'll talk about in a minute, will cause fuel prices to rise, and that will have a negative impact on inflation. Food and non-alcoholic beverages rose by 13.4% in January month. Bread and cereals were up 21.8%. And of course, we have the imminent 18.65% hike in electricity prices, which has already been approved by the National Energy Regulator, and that will not help. Despite all of this, inflation is expected to be back inside the Reserve Bank's target range this year. In other words, it will be below 6%. ABSA's Production Management Index for January was almost unchanged from December, which shows that businesses are reducing their reliance on Eskom. And this is something that I think is very important for everybody to understand. Most companies have a plan or a mechanism that they are going to use or are using, which enables them to avoid using Eskom's power. For example, Aspen is planning to be completely independent of Eskom in 18 months from now. And the same can be said for many other major companies like Pick n Pay and many others. They all have a plan in motion to get away from Eskom, to generate their power from renewable sources. And I think this movement away from Eskom is going to result in a huge burst of efficiency within the private sector in South Africa. We are basically being forced to move away from carbon emissions at a much faster pace than we would otherwise have been. And of course, once you've got a solar installation in place, the power that you get from that is cheaper and more reliable, which basically means that your business becomes more profitable and more efficient. In 2022, last year, South Africa imported 5 billion rands worth of solar panels, enough to put in 2 gigabytes of solar power. So that is very significant. It shows you that private persons, ordinary consumers and businesses are putting up solar panels on their rooftops at a rapid rate. Cyril Ramaphosa, our president, is looking to rapidly add 8 gigabytes of power to the grid. That's through his new committee, which is involved in trying to sort out this power problem. I'm not sure how successful they'll be in doing that. They'll probably get some of it, but not all of it. But the main thing to hang your hat on is that consumers and businesses are moving away from Eskom at a rapid pace. They don't have a choice. This load shedding is forcing them to do that. At best, Eskom can be seen as a backup electricity service, nothing more. All right, business confidence rose in January, mostly because of an increase in tourism and new vehicle sales. ABSA has been predicting that South Africa will fall into a recession sometime in 2023, mainly because of load shedding. They are predicting that gross domestic product will grow by only 0.7%, but it's still more than double the Reserve Bank's 0.3%. But Standard Bank and PricewaterhouseCoopers are predicting 1.3% growth this year and 1.6% growth this year, respectively. So I think the Reserve Bank is right at the very conservative end of those predictions. Just looking briefly at the mining sector, mining contributed about 88 billion rand in tax revenue and royalties to the fiscus this year, in the year that ended in end of February 2023. They also generated about 900 billion rand in export revenue. In fact, they accounted for over 40% of total export revenue, which shows you that South Africa is still an export-driven economy. Mainly base and precious metals. That's what we export. Of course, Transnet has made this all more difficult through its inefficiencies, and those inefficiencies are thought to have cost the fiscus, just the tax collector, about 50 billion rand in lost tax. And load shedding, of course, remains a major problem. Most mining companies are implementing an alternative energy strategy of some kind. Gold Fields is in the process of installing a 50 megawatt solar farm at South Deep. And that's just an example of how mining is moving away from Eskom. Mining production, however, in December was down again by 3.5%. That's the 11th consecutive month's fall. And our esteemed Minister of Energy and Mineral Affairs, Gwede Mantashe, says that the backlog of mining license applications has halved. At the moment, South Africa gets about 1% of the world's mining exploration spend. Mantashe says he wants to increase that to 5%, but he's been there for an awful long time. And in fact, he is part of the problem, from what I can see, not part of the solution. Mr. Kieswetter, who's the head of SARS, says that load shedding will certainly impact on tax collections this year. Consumers and companies are diverting cash to implement alternative energy solutions, and this will lead to more tax evasion and avoidance. I'm sure he's quite right about that. Load shedding will also impact on fixed investment, which fell by a third in 2022 from 2021. The 200-plus days of load shedding in 2022, plus the slowing world economy, have resulted in lower foreign direct investment in South Africa. Neil Froneman, of course, who's the CEO of Sibanye, probably the most respected mining conglomerate to come out of South Africa at the moment, says that South Africa has become an unattractive destination, an unattractive option for mining investment. The value of new projects in South Africa fell to 250 billion rand in 2022 from 2021's 400 billion rand. So that gives you an idea of what overseas investors think about this country. South Africa has a population of about 40 million people capable of working, people who are in that age group who are capable of working. But out of that 40 million, only about 16 million are registered taxpayers. And of those 16 million, about 330,000 earn more than R1 million per annum. And they pay about 41% of the total amount of income tax collected. It's important to realize that these people are highly mobile and can easily move overseas. Edward Kieswetter, who's in charge of SARS, says that about 6,000 taxpayers left the country last year permanently. Add to this that about half the population depends on social grants for their survival. And then you'll see that the fiscus is constantly trying to fund growing expenditures out of a shrinking revenue stream, and that is not good. The Reserve Bank's leading indicator fell by 4.5% in the year to the end of December, and that comes after November's downward move of 2.8%. 10 of the 12 components of the indicator were down, and that indicator is supposed to show where the economy will go in the next 12 months. In other words, it's supposed to give us a prediction. And if we look at that prediction, it doesn't look very nice. Okay, let's look at the Rand now. I'm going to just quickly put on your screen the Rand chart so that we can have a quick gander at it. Okay, I think I'll put a 2-year chart, 5-year chart. Right. So there's a 5-year chart of the Rand against the US dollar. What you must remember about this chart is that it's basically inverse. When the chart is going down, it means that the Rand is strengthening. When it's going up, it means that the Rand is weakening. So this is a period of strength which started in about April, May of 2020 and went all the way through to June 2021. From then on, we had a weakening trend, and that weakening trend is persisting until today. I've marked on here where the bear trend on the S&P 500 began on the 3rd of January 2022. The Rand continued to strengthen for a while, but then suddenly picked up the negative sentiment from America and started to weaken. You can see also that there seems to be a support level here at about 18.60 Rand, and obviously a penetration of that going to worse than 18.60 Rand to the US dollar will negatively impact the trend. And it will show that we are having a resumption of the weakening trend that we're in now. I have explained to you how the S&P 500 is linked directly to the Rand, and that is because when people sell out of the S&P 500, it is usually because they are moving into a state of risk off. In other words, they are not interested in taking risk. And that means that they move money out of emerging market currencies like the Rand and into safe assets, what are called safe assets like US Treasury bills and so forth. And that causes the Rand to weaken. So much of that negativity, much of this fall in the Rand has got to do with risk-off sentiment from overseas. But this latest burst of weakness, I think, has a lot to do with local factors like load shedding, like De Ruyter's interview, which showed a lot of corruption in South Africa. I think it's impacted on overseas investors and their willingness to bring money into this country. So we're now looking at a situation where the Rand is close to 18.60 Rand, and that obviously means that we will have a strong hike in petrol prices this month and probably even next month. Okay, so the Rand weakness is an important factor, and it impacts on international investment sentiment. Of course, central banks around the world are raising interest rates, and that portends an impending world recession, which is being predicted by a lot of economists. The S&P 500, as I've pointed out to you, is in a negative bear trend. which we expect to continue. So we expect the rand to continue weakening at this point. The third bear trend rally is over. The S&P is falling back, and it's taking the rand down with it. Okay, let's look at a few companies that may be of interest to you. I'd like to start by looking at Capco. Capco is an interesting company. It's a real estate investment trust with a primary listing in London and a secondary listing on the JSE. It's big enough to be part of the FTSE 250 index. And the most important asset which it owns is Covent Gardens. In fact, 94% of its assets are its investment in Covent Gardens. Covent Gardens is one of the most visited shopping and residential and office destinations in London. So this is a fantastic rand hedge share, and it's got enormous growth potential. It took a big knock during Brexit, but it is now recovering. The balance sheet is very strong. Even after the purchase of Shaftesbury, the loan-to-value for this company is 21%, which is very, very healthy indeed. Mostly investors and investment analysts get unhappy when a real estate investment trust's LTV, loan-to-value, is above 40%. So 21% is very healthy. You can see here on the chart the share made a double bottom in September and October last year and has now started to move up very, very strongly. So we regard this share as a good value and probably with a strong future. It's also got the advantage that it's a rand hedge. So it's one for you to look at. Okay, let's look at another favorite share of ours, Hudayco. Hudayco is an interesting company. It has, if we look at it, actually put even more data on the screen, even 10 years on the screen. Right, maybe that's a bit too much. But what you can see here is that this company has a long track record on the JSE. The share price has been falling since 2018, and we advised quite a long time ago during this downward trend and during COVID, we advised you to wait for an upside break through this downward trend line. That upside break came on the 27th of January 2021. At that time, the share was it was just 90 Rand. It has subsequently moved up very strongly, nearly doubled. It's now at 169 Rand 52. That's where it closed on Friday. What we like about this share is it's quite diversified. It's got a lot of different businesses, each one of which is profitable. But the important thing is that they have made a science out of adding bolt-on acquisitions. And that enables them to grow their business by buying companies. I mean, last year they bought Kodak. And you know Kodak, the people who supply gas cylinders and Squattlebries and all that kind of thing. They bought Kodak. Profitable business. They bought it for 3 or 4 times its annual earnings. And of course, it will be now re-rated to be at the same PE as Hudayco, which, as you see on the screen there, is about 8.6. So that immediately gives shareholders a gain, because the profits of Kodak are now at 8.6 times annual earnings instead of the 3 times annual earnings that Hudayco paid for it. So at a PE of 8.5, we think this share is still a very good value, and it's one to get hold of. All right, the next share is William Bailey Holmes Ovcon. This is now the largest construction company in South Africa. You may recall that after the 2010 World Cup, the ANC set about destroying the construction industry, and that led to the demise of companies like Aveng and Murray & Roberts. So now William Bailey Holmes is the country's largest construction company. As you can see, there's the downtrend, but what I want to point out to you is that there appears to be an upside break here. That's the important thing that we're looking at. WBHO is rebuilding itself and getting rid of unprofitable divisions. It has a market capitalization of about 6.4 billion. And in its trading statement for the 6 months to the 31st of December 2022, it estimates that headline earnings per share will be up by between 35 and 40%. So this is a company on the mend. And as I said, there's a break up through its long-term downward trend line, and that's always a good sign. Okay, let's talk about Naspers and Prosus. As you know, these companies are very heavily invested in the Chinese firm Tencent, and that company has been taking a bit of strain because of the COVID-19 in China. And the best way to look at the Chinese economy is through the Shanghai Stock Exchange. So you go to the SSE. The SSE is the Shanghai Stock Exchange's index. They have various indexes, the composite index and this one, which is the 180. So it's the biggest 180 companies in Shanghai. And as you can see, it's been in a downward trend because of COVID. But now we seem to have an upside break over here. That's what I want to draw your attention to. You can see it broke up through the trend line over there and then came back to the trend line. So the resistance became support over here. And now it looks to be in an upward trend. Goldman Sachs, which is a big international company, says that the removal of COVID-19 restrictions in China will result in the Chinese stock market, the Shanghai, going up by at least 21%. A major beneficiary of that will clearly be Tencent, and that will benefit both Naspers and Prosus. Of course, Prosus has the advantage that it's listed on the Amsterdam Stock Exchange, so it's basically a rand hedge, and that is a big advantage. Naspers is local and is listed here on the Johannesburg Stock Exchange. Doesn't have the same rand hedge capability, but it is still a very good share, and we believe both Prosus and Naspers are undervalued at the moment. The last company I want to talk about today is Bidcorp. Bidcorp is a diversified international food company which operates in about 34 different countries. I just want to put more data on the screen here. There we go. So that's a 5-year chart of Bidcorp. You can see that it's a solid blue chip share. It's also a rand hedge share because 95% of its income comes from outside South Africa. In its results for the 6 months to the 31st of December 2022, revenue was up 28.1% and headline earnings per share jumped by 45.5%. Some of that, of course, was due to the fall in the rand. But as you can see here, from the chart, there was a resistance level here at 354, which was established way back in November 2019. It was touched here again in February 2022, but now we've got a clear upside break, and in my opinion, that looks good. That is technically very solid as an indication that the share is going to continue upwards now. Okay, folks, well, that's about what I have for you today. I hope that you found something of interest here. And remember that we will be doing another one of these webinars on the first Wednesday of next month of April. So I look forward to talking to you again then. Thank you for listening.